Hey everyone, happy Thursday, June 19th. It's about 8:15 in the morning on the West Coast, and it's time for another market update. It was another interesting week in the markets. I don't think we have an uninteresting week the last few years, but first things first, war broke out. There was a conflict going on in the Middle East between Iran and Israel, and the main way this could affect mortgage rates and affect the markets is it could make oil prices higher. And if oil prices go higher, then inflation tends to go higher along with it. Besides the obvious energy usage, basically in this country, at some point, everything that gets delivered to a store somewhere is on a truck, and a vast majority of our trucks and auto in this country, run on gas, and so they need oil. So, that's where that could trickle down. And so, besides the humanitarian, no one wants to get killed. We don't want to see anybody get killed. As far as mortgage rates and stuff like that goes, we don't want a war because that could create, higher oil prices. So, fingers crossed that gets resolved quickly and peacefully. Next thing, so this was Fed meeting week. The Fed met for the last 2 days, and then yesterday, came out, released their statement, and had their press conference. And as was fully expected by the markets, I believe it was 99.5% chance they stayed where they're at. They did not make any cuts. The important about this specific meeting is about half the meetings throughout the year we get what they call their summary of economic projections. So they come out and say what their inflation rate, all that kind of stuff. They also release what they call their dot plot graph. So they're basically showing each member how many cuts they think they're going to do the rest of the year, and so that's something obviously the markets are going to pay very very close attention to. And right now, I believe a majority are still showing two cuts this year, which is good. If we get two cuts, we're already halfway through the year. That would be great. But the one thing that did tick up was previously only four of the members, I think out of the 19 members, believe that there'll be zero cuts this year, and now that's up to seven. So that's heading in the wrong direction. More of the voting members, more of the Fed board members, whatever, are thinking maybe we have zero cuts this year. So still majority think two. But that had crept up. So, but overall, it was a very tame. The markets didn't really react at all. Mortgage rates stayed exactly where they were. U.S. Treasury stayed where it was. Overall, it was a pretty mild day. Like I said, didn't like seeing more members thinking no cuts. They didn't like that, and then inflation projections for the Fed released went up a little bit higher, and they still keep talking about tariffs and when is tariffs going to affect stuff. So they're waiting for the impact of tariffs. That's basically what they're saying is we don't have to do anything. We're good now. We need to wait and see, in the next couple months how tariffs affect inflation. So that again makes me think, if we didn't have any of these tariffs going on, where would rates be? I think they would have cut by now because inflation data looks great. So again, pretty mild meeting though, not market moving. Everything was accepted pretty evenly. Next thing, the one piece of real, hard data we got one of the hard pieces of data we got this week is May retail sales, and that was down almost a full percent, negative 0.9% month over month, and April was revised down to negative 0.1, and I believe it was 0.2 previously. Looking at that in graph form. And again, the reason this is important is retail sales obviously is an indicator of how we are doing, as consumers. Do we have money to spend? The more money we spend, the higher U.S. retail sales is. When we tend to see this drop is when people don't have as much money. So last 2 months have been negative. It's also very important because this goes into the GDP calculations, and anything that makes our economy look weaker is increases the odds that the Fed will cut rates. So that's one reason why if you work in retail, you probably don't like seeing this down, or if you own retail or whatever. But in our industry, retail sales being lower right now means less inflation and hopefully a rate cut coming up. Next thing, May housing starts and permits. So again, we look at this always. This is always very important because this gives us an idea. This is new home construction. This gives us an idea of future inventory. So permits down month over month, starts down almost 10%, construction down 1.5%. Only thing up was completions, 5.4%, but they're all down year over year. And really, this starts, permits and starts are our first indication. Permits, the very first indication, what new housing we're going to get. But, people pull permits, then don't end up building for whatever reason. Rates are too high, things like that. So starts is, that's when they've broken ground. That gives us an idea that definitely this house is going to be built, 95% of the time or whatever. So this gives us an idea of, future inventory. And right now that's running at about 1.2 1.26 million, annually. And again, down 10% month over month, 4.6%, almost 5% going back to last year. So that's not a great sign, as far as future inventory. Right now, I think the 5-year average, we're running at about 1.8 million household formations. So that means, how much demand is. And so we're, basically running behind demand. Demand has slowed down in the last few months, last year or so. But as soon as rates kick down, which hopefully they will, you will see that demand kick back up and we just won't have the inventory. And so that is good for current homeowners. If you're a current homeowner and, you have less competition, that means that's going to be price supportive. That's good for you. Your house will appreciate more. People that want to get into the housing and buy new housing, that means less supply out there, which tends to mean higher prices. So, good for, like I said, anytime we see these numbers, it's basically good for current homeowners and just doesn't, show a lot of strength as far as, what housing we'll have available later. And the other part about this that came out this week was, for the month of June, we got the NMHB, so National Association of Home Builders, their home builder sentiment. So I don't always look at this, but this has been falling quite swiftly. We're down to 32. Anything under 50 is a negative feeling. Future sales expectations down, current sales expectations down, buyer traffic is down. So according to home builders, and again, maybe they're being a little sensitive, about it. Maybe they're being a little pessimistic about it. But according to home builders, at least, they are feeling very negative. I know I saw some stats about as far as how much money all these home builders are giving away and in builder credits and to get the rate down and all that. They're cutting in their margins quite a bit just to get the houses off their books. So again, combine this with housing starts and permits, it looks like home builders are, headed into a rough patch, especially if rates stay where they're at. Next thing we got, initial jobless claims came in about 246,000. It was expected to be about 248,000, but they are more elevated. The last 4-week average, we're riding this 245, 250K average, which is comparative to where it was a few months ago down in the 220s. It seems like it's, creeping up. So it's something to keep an eye on. And again, don't want people to lose their jobs, but the more weakness in the job market, the more likely the Fed will cut their rate to to stimulate the economy. So that's why, unfortunately, we got to keep an eye on that and hope for those numbers to get a little bit higher. So where does that leave us? We're basically the same exact place we were last week when I talked to you guys, 6.87. The markets are actually closed today for Juneteenth, but so no movement today, but it ended the day after the Fed meeting at 6.87. So last week we're at 6.87. We've been in this range for quite a while, it seems like. But considering a new war broke out, the Fed met, and things like that, not a bad result for the week to kind of stay where we're at and not jump up a little bit. So good to see there, but definitely want to see this come down further and further. The way we'll get there is some of these reports coming up, coming in our favor. So Fed meets next July 30th, coming up in a little over a month. Right now, it's about 91% chance that, the markets think they do nothing, 9% chance they cut. Between now and then, we're going to get probably 2 PCE reports. The first one coming up here in 8 days. Next Friday, we get the PCE for the month of June. I'm sorry, for the month of May, and then we'll get the BLS jobs report for the month of June, the beginning of July. We'll get another inflation report, CPI, mid-July. We'll get retail sales, all these other things as well. Who knows what's going on with tariffs? Who knows what's going on with Israel and Iran? And add all that stuff up, and we got the Fed meeting on July 30th, and that's when they'll make their decision. Will they cut? Will they stay? Right now, the markets think they're going to stay where they're at. But, if some of that data comes in our favor, some of these other global things kind of settle down. So the markets, Fed could just look at the data. Maybe we'll get our cut. So if anybody needs anything at all, don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.